Hi, welcome to this video today, which is all about Forex trading basics for beginners. We're going to be looking at getting a trading strategy that can lead you to success. Now, in terms of most new traders, when they enter the markets, they pick strategies that plainly don't work. They do not research the logic, okay? And this includes, I've met people with master's degrees, high intelligence, and they think a strategy is going to work. And yet it plainly doesn't, because the logic is unsound. Now, in relation to this, if you're coming in the markets, this video is obviously for you. If you've tried a pattern trading strategy, let's say Gartley patterns or let's say Elliott wave, and wondered why it doesn't work, I will explain, and other strategies that don't work, and go through simple strategies that do. Now, why do so many traders, even with high intelligence, pick the wrong strategy or method to use? Well, it's down to what is called in psychological terms subjective validation, and then confirmation bias coming in to play, which the Forex industry knows, okay? Strategies are sold, probably hundreds of millions of dollars is turned over because vendors know those two subjective biases will make, normally logical people totally illogical. Now, what I want to start off with in terms of my introduction, which might seem kind of strange, but it will actually make sense in a moment, is I want to do a quick psychological test. Okay, I'm going to give you the results of my studies of numerous Forex traders in my 30 years of trading, and I've done a personality profile. It's only going to take about 40 seconds, okay? See if this personality profile you relate to. It's just coming up on a quick storyboard, then I'll be back to discuss. Well, back off that short typical personality of a Forex trader. Now, does that accurately reflect your personality? Should do. Reflects almost everyone's, not just Forex traders. I made up the bit about I studied Forex traders. I didn't. I just took that summary from a very famous psychological test, which was done by a guy called Bertram Forer, to prove that humans are basically prone to subjective validation. What does that mean? It means that basically you will take a generalized statement and match it to you or your needs. Now, why is that important in Forex trading? Because subjective validation is very powerful if you put a hook in or a benefit, which vendors of losing strategies do. Then what they do is they work on bringing out confirmation bias within you, which is a bias that we're all subject to. And your confirmation bias will work to convince you of something that is totally wrong, but you're actually very good at it. All humans are. This needs a little bit more explanation, and then you can see why so many people go for losing strategies. And I'll go through my evidence of strategies that lose and give you some examples of simple strategies that you can make money with. So let's go and look at a few key points in relation to this. Right, I'll just go through the four effects, and in terms of Forex education, it's known, okay, by the people marketing, and they will exploit it. And a lot of beginners actually buy or follow strategies and techniques that just don't work, okay? I'm going to go through techniques that work and techniques that don't in a moment, okay? But I just want to go through the Forex. It's interesting. And a lot of traders just simply don't think about it when they come in the markets. They don't do their research. They end up with strategies and techniques and so forth. They're just basically going to lose some money. Right. Forex has a tendency to believe in vague or appealing statements which are applied to everyone. Okay, so we saw that with the personality test. Okay, it's known as subjective validation in psychological terms, which means you're very vulnerable to suggestion when the subject is you, and you're particularly vulnerable if you can benefit from the message. Okay, now in terms of subjective validation, what really gives it its power is hope. Okay, when you want something to be true, okay, and if you think about Forex trading is about making money, we all want to make money, you'll look for ways to believe it. Okay, and most traders just hope they're going to make money, they don't actually believe it. Okay, now keep in mind this next point, because it's very important. Your brain doesn't like disorder or uncertainty. You like certainty. Okay, now in terms of, if a Forex educator is using subjective validation, okay, they'll also want to give something that will make you subject to confirmation bias. I'll just discuss that in a moment, but I want to read this quote actually. It's very good actually. It's from behavioural psychologist David McCraney. Right, when you need something to be true, you'll look for patterns. You connect the dots like stars in the constellation. As you attempt to make sense of the world, you focus on what falls into place and neglect what doesn't fit. And there is much that doesn't fit. Now, in terms of subjective validation, anyone can do it easily. You can make money. There's a subjective validation put in front of a trader. Then you want confirmation bias, okay, to come into play. So presentation of order and patterns, okay. So technical analysis. That is the confirmation bias. Because what traders will do, or new traders or beginners, they will look at what's presented to them in terms of the patterns on the charts, and they look like they're going to work. Okay, now in terms of humans, we like to see patterns. Okay, we're genetically programmed. Okay, so when you recognize your mother, what do you do when you're first born? You pattern match her face. Okay, people see patterns everywhere. You might see a pattern or a face in a cloud or something like that. We're just designed to look for patterns. So, beginners when they come in the markets, want to make the money. They want to make it easy, and the way to do it is using technical analysis and patterns. And the actual Forex industry makes hundreds of millions, probably more a year, by ramming home this message. Okay, and what I want to do now is just go through what I would consider to be technical analysis that doesn't work and technical analysis that does. In terms of technical analysis that doesn't work, it's the majority of education online actually. And I can basically prove with facts that it doesn't work, and then I'll give you technical analysis that does work. So right, let's look at technical analysis in more detail and see what we need to avoid and what type of approach we need to make money. I will come back after that short summary there in terms of why traders buy strategies or use strategies that will not make them money. Now, I'm going to go through the strategies that won't make money and the strategies that will make you money. Now, in terms of my summary, I would encourage you, just don't take my word for it, go and do your own research, and you'll come to the same conclusion that I have, that the majority of traders who enter the markets and start to trade pick strategies that simply are based upon flawed logic and can never work. Right, let's go to a storyboard, look at strategies that are destined to lose, and also some simple strategies that can lead you to success. Right, let's have a look at some strategies that work and some that don't. We've already seen that we are genetically programmed to see patterns, and you'll see lots of patterns when you look on a Forex chart. But of course, another bias comes into play here: hindsight bias. And all the fancy pattern formations are subject to that. You could only see them in hindsight. Okay, you know the price action already. That's easy. You've got to trade it with an entry, stop, and target. It makes things much more difficult, okay? Let's take three popular pattern strategies I think you should avoid. Gartley patterns. These things are absolutely ludicrous in my view. You've seen them. Ciphers, bats, butterflies. Vendors claim they work, but no evidence is ever given. Let's just look at where they come from. An obscure 30s newsletter writer who never bothered even trading his own method. Well, if he didn't have the confidence to trade it, why would you want to trade it? Okay. Elliott Wave, Thomas Elliott, well, he did actually have a go with this strategy. He claimed to be able to predict the future, not just in Forex markets, but in anything. Died in poverty, so obviously didn't work for him. So I think that's one to avoid. Fibonacci retracements. Fibonacci, brilliant mathematician. However, he was not a Forex trader. He was around in 14th century Italy. He was just coming up with a number sequence to prove exponential growth, nothing more. People have taken his number sequence, taken numbers out of it, and said that Fibonacci retracement percentages are levels that can hold and break. Normally when you see Fibonacci used, they put so many different levels on the chart. It's bound to break or hold some of them, depending on what they're trying to do with the chart. But just skew the percentages by just a few points either way, you get the same results. It's just nonsense, okay? General pattern trading mistakes. You get a lot of advanced trading patterns, but advanced doesn't work in Forex trading. Why? Because you've got too many inputs, or the lines are curve fitted to the chart. So you bend the formation to the price action. The more variables you have in a method, the more likely it is to break, because Forex prices never repeat the same, exactly the same going forward. So again, another mistake. Diagonal lines. You can always tell traders who don't make money by the way they use diagonal lines. Okay, so let's take a really good example. Through one level only, so let's say through one price peak, it'll be drawn at a certain gradient to prove what is going to happen next. How can you do that? You can have it at any gradient you want if you're going through one level. So that's total hindsight bias. Taking diagonal lines too far back. I've seen people draw support and resistance lines or channels diagonally going back a year or more. Well, why is the price a year ago got any relevance to the price today when traders are focused on the price today? Again, it's hindsight bias. Most pattern trading strategies, the person promoting them will tell you they work in short time periods, the 5-minute chart, 30-minute, hour. No strategy will work in that shorter time period because you're just trading market noise. But again, it appeals to traders who think they can keep their risks low, make small regular profits. Total myth. Coming to strategies that work, price action trading or trading with indicators. I don't think it matters. As long as you keep it simple, that's fine. I will normally use one or two indicators to back up my view of support and resistance. Okay, but it's just a personal choice. Now, in terms of strategies that work, which are good ones, I'm just going to give you some examples. You'll find obviously more if you do your research. Breakout trading from tight ranges. When you've got prices moving sideways, volatility is low, then prices break out of the range on high volatility. They always offer good risk to reward trades. Why? Because the supply and demand situation behind the chart has probably changed. Okay, always offer, for me, good risk to reward opportunities. I also like big levels of support or resistance, like coming through big daily levels, weekly or monthly levels, big supply and demand levels, normally a straight line as well. In terms of volatility, I always think trading high volatility is a great way of trading, because any price spike, big one, to the upside or downside, is driven by human emotion. People get too bullish on the upside, too bearish on the downside. The price spike will fade. Okay, you can just go and look back on any chart and see that is so. So there's just a few examples of trading strategies you can research that do work. In terms of final words, it doesn't matter what strategy you do use, you've got to learn to read the tape. And by that, I mean all chart formations, even if they're simple, are subtly different. If you get used to the candles and the way they're moving, you'll basically pick up the human psychology behind the chart that never changes. You've got to have experience. There's no way around it, okay? And you can't just use a one rule set all the time. You've got to have a degree of flexibility, but anyone can do it, okay? But I think traders, they don't like uncertainty, so they don't want to do it. They don't want to go through the learning curve. So that's why they go for the set strategy, the mathematical strategy, or the pattern repeat, okay? In terms of the number of losers in Forex trading, it remains constant. It's 90%. That has never changed. Never will change. That's your real secret to trading success, because if you think about it, no advances in technology have helped improve the number of winners. So that disproves the idea that advanced methods work. It's down really to human psychology. And most traders can't control their emotions, and most traders, will not go through that learning curve, just getting a very simple strategy and learning how to apply it. I mean, that's all it is. Anyone can do it. You don't want to do anything complicated in Forex trading. Also keep in mind, anyone can learn to trade Forex and make money, but it's obviously not easy, okay? That's why 90% of traders lose. But with a simple strategy and getting the right psychology, you can win. Right, so I hope you found the video useful. That is the video for today. Thanks for watching me. Take care. Have a good day.